Just going to wait just another minute, just in case we have a few more late arrivals that we see coming through. Just in the meantime, just to present a little bit about our APM Capital. We're a regulated broker headquartered in Abu Dhabi Global Markets. We offer trading solutions to our clients. We offer foreign exchange and CFDs via the MT5 platform, and also we connect our clients to the world's derivatives exchanges, the premier being the CME group, and we're pleased to have our clients trading successfully with the CME exchange. Today's webinar is a series of three. This is the second of three webinars that we're doing, and we've got an in-person seminar coming up as well at the end of that in November. Today's webinar is on the subject of exchange fundamentals. We're very pleased to have David Gibbs with us. He'll be giving the presentation today. We will have opportunity to he will be able to answer some of your questions if you just want to pop those into the chat, and we can address those at the end. David himself is the Director of Education at the CME Group. He's a market professional with over 40 years of industry experience. He began his career in the open outcry pits in the Chicago Futures Exchanges. He's held leadership positions with global FCMs and has actively traded futures, options, and cash market products for both buy-side and sell-side firms. He's an expert in pricing derivatives, including financial futures and their underlying products. And he's also a noted teacher of the application of futures and options and how they're used successfully by professional traders and managers in today's increasingly unpredictable economic environment. Today, I think we'll be covering areas such as the participants, technology, risk, and just the overall trade life cycle. So very interested to hear from a man in the know. So thanks very much for joining us, and thank you, David. Over to you.
Thank you, Mark. That intro sounds I think a little more impressive than things really are. But thank you so much for that. And delighted to be here. CME is delighted to be partnered with APM, offering the series to give you a little bit more of an understanding of our marketplace, how we work, and how it benefits you as a trader or a risk manager. We're going to be covering, as Mark said today, more of the operational side of the business. And this is important for you to understand because it's where the rubber meets the road, or it's what affects you directly. Understanding about how to gain access, the risk management controls that are in place, both on the Globex electronic platform as well as the post-trade clearinghouse aspects, are key to understanding how our markets work and what differentiates CME from, say, the OTC marketplace, and also in many cases other exchanges around the world. So I need to begin by first stating that our session together is meant to be educational and informative, and in no way is meant to be construed as offering investment advice nor making any trading recommendations. We're going to be talking about the markets. We're going to be talking about trading, but please don't take that as an endorsement to trade. I always recommend that you do your own homework, investigate these things on your own, and of course, work with your brokers to understand the risk parameters as well as the potential benefits of our markets. So what is CME all about? Well, in its simplistic and simple forms, it all boils down to one little word: risk. In English, it's a small word. It's just 4 letters long, but it's a big deal. The thing about risk is it's different depending on what business you're in or what industry you're in. We exist as a place for commercial and institutional users in various industries from around the planet to come to manage the risk that they already have or that's inherent in their business. Our purpose isn't to create risk, it's to help people manage it. And we've developed products and services to aid people from many different industries around the world, around whether it's agricultural industry risk from the producers or the farming community that produce those products, to the processors that turn it into the food that we see at the supermarkets, to manufacturers who have either input or outputs costs and pieces that might have to be imported or exported that face foreign exchange risk in the development and transaction of those pieces. Our energy markets aid both the producers of the energy as well as the big consumers of energy. And in the financial space, in terms of equity index and interest rate products, as well as other aspects of the capital market area, risk managers that manage our pension risk, insurance portfolio risk, as well as banking and regular capital market cash flow risk. All of these things are examples of industries which come to CME to manage the risk that's inherent in their business and their operations. And what we've tried to do over the years is develop basically a toolbox of derivative product tools in the form of standard futures and options on futures, as well as the clearing mechanism to help them do just that. Obviously, there's different tools for different jobs, so finding the right tool for the right job is important. And then understanding how to use those tools effectively makes the difference between success and failure. In order to create this marketplace, we need to bring together as many individual users of the market as possible. This generally comes down to basically two types of market participants. I've talked about people that come to CME to manage the risk that they already have. We call those types of market participants hedgers. They're hedging or selling risk that they already have. They're using our marketplace and our products to lay off or hedge risk that exists already in their business. But in order for them to sell risk, somebody has to be willing to buy it. In some cases, it could be another hedger just on the opposite side of the risk equation from the risk that's being presented. But in many cases, and I would say in most cases, it takes another market participant who comes to our market with new capital, seeking to benefit from buying risk. We refer to these in the industry as speculators. Now, that name itself conjures up for many of you perhaps negative images of nefarious characters who prey on the weak and the unsophisticated to take their money. There are certainly have been examples throughout history of very, very bad speculators. But in our marketplace, which is very, very heavily regulated, in which we monitor very, very closely, is not the case. We do have laws, regulations, and market principles in place. Should that type of activity occur, those speculators that are behaving badly are prosecuted. We'll get into a little bit of that later on in the program. But what in the mean, 99.9% of these active speculators are providing a very necessary part of the marketplace. They're providing what is known as liquidity. When you're trying to create a balance between hedging and speculating, the more participants you have, the better. When you've got a lot of bids and offers, a lot of people who are active buy and sell, they're competing for price, which means they're drawing the bid and offer spread closer together. And the more volume on both sides you have, the easier it is to get in and out of a market. This is what's known as market liquidity. So our goal is to bring as many people together in our marketplace as possible, creating these deep pools of actionable liquidity in our products, which leads to market efficiency, both in terms of the key aspects of our business, which are price discovery and risk transfer. We're certainly not the only game in town. Every major capital markets city in the world that has a marketplace will tend to have a derivatives business, either in the form of a regulated exchange or in the form of an OTC marketplace. Listed futures and options takes place on every major capital market city in the world. We happen to be probably the largest in the futures and options space, but certainly not the only. And what you're looking at here is a graphic depiction of that global marketplace represented from data from the World Federation of Exchanges, which is an association of at least, I'd say 50, maybe 50 plus exchanges around the world that report their volume, their open interest in the various products that they list. And the World Federation of Exchanges puts out an annual survey of that activity. And this the slide in the chart here that you're seeing is the result of the data from that group. This is the latest version, which was published this last April. And you can see by the gray bars in the chart, increases in trading activity represented by numbers of contracts. Those are millions of contracts traded. The lines, the different colored lines, are showing you the regions generating those volumes. The green line showing EMEA, the purple line, APEC, and the red line, the Americas. And you can see the huge growth in the Asian Pacific region over the last year, primarily from trading activity in India and China. This is also illustrative. This is showing both the growth in total numbers of derivative contracts traded, but breaks them out by green and red line by futures contracts and options on those exchanges. And you can see the red line showing very nice progressive growth in futures, but maybe more important to this illustration is the very steeply upward sloping green line. This indicates an enormous increase in the trading of options in our markets. It's certainly true at CME Group, but it's clearly true all around the world on various other exchanges also, that there's been a tremendous increase in the last several years of activity in listed options. And in the case of CME, these would be options on futures contracts. We've been asked and have been responding to demands to list more and more shorter dated options expiries, resulting in more shorter dated options trading in our platform. These are going to be subjects we're going to be talking about a little bit more today, but in greater detail in our next webinar series, as well as on our in-person event in November in Dubai. I mentioned earlier about creating this metaphorical toolbox. Having the right tool for the right job is important, and depending on who the risk manager or the trader is, you're going to have different requirements and may require different size futures contracts. One of the things that we've done at CME, in addition to our standard size futures contracts, is to launch what we refer to as micro size, usually 1/10 the size of the standard contracts. These contracts are the same in every aspect as the standard size contract, only they're simply smaller in their notional size, and as a result require a smaller amount of performance bond or margining to secure them. So having the opportunity to size your risk or size your trading vehicle could be meaningful, particularly for the self-directed trader trading his own account. The standard size contracts may be too large or may not represent enough granulation to get to the risk number that you're looking for. The micro contracts may be just the right tool for that job. So looking at the global derivatives space, exchanges make this real contribution to the economy, which is to provide, in our case, transparent, efficient price discovery, and to create that place where there can be this efficient and safe transfer of risk from sellers of risk to buyers of risk. This is backed up by the post-trade risk management functions of our clearinghouse. And central clearing, which is a hallmark of the exchange traded and cleared space, at least in the Americas, is marked by this central clearing mechanism that we're going to talk about a little bit more in detail in a few minutes, and marking to market, which is a deeply rooted foundational aspect of the U.S. futures market, where everyone gets the same settlement price every day. And then results in the margining or the collateral that must be placed to secure those open positions, reducing the systemic risk to all of us in the futures trading ecosystem at CME Group. So just to underscore a little bit further, these are the main functions of the exchange business at CME Group: the discovery of price, which is a competitive, market-driven function, and then the execution of the trade, transferring risk from one participant to another. In order to have a trade at CME, you've got to have both a buyer and a seller. That's the point at which that transfer mechanism takes place. So we built, over our 170 plus years of operation, a very, very wide range of benchmark futures products. Beginning with our oldest asset class, which is agriculture, we have 5 additional contracts or asset classes. The agricultural space, known for the grain and livestock markets, but we also have dairy and fertilizer included in that space. Other industrial commodities traded at CME include things like crude oil, natural gas, and some of the refined products in that area. Our metals business is broken into both precious and base metals, precious including gold, silver, platinum, and palladium. In the industrial products, leading products, aluminum and copper. And then on the financial space, the oldest financial products at CME involve currency risk, or the FX marketplace, extended in the 1970s to include interest rates, primarily US dollar rates, but we've listed recently contracts in non-dollar products, including Ester, which is a euro-based interest rate, and a FTIA rate, which is a Mexican interest rate. And then in the equity index space, we've got benchmark products on the leading US and some foreign equity index products, also specialized products like select sector futures, as well as total returns futures and futures on dividends. We even have futures contracts on some esoteric things like cryptocurrencies, real estate indices, and weather products. So it's this big basket or big bucket of, or toolbox full of tools covering primarily 6 asset classes, each with deep pools of actionable liquidity available on our Globex electronic execution platform. It might be useful to spend just a few minutes, and I mean just a few minutes, going over where we come from. CME grew up as a regional exchange business in the United States, primarily focused on agricultural products. We go back to our oldest legacy exchange being the Board of Trade of the City of Chicago to 1848. There were commodity exchanges in lots of other cities in the United States then and towards the turn of the 20th century, but the business tended to coalesce in Chicago because of its access to transportation routes, both water transportation and especially rail transportation. So what developed were these large buildings, exchange buildings, that included very large trading floors, like you see in this picture of the old Chicago Mercantile Exchange, with trading rings, which we referred to as trading pits. They're called pits because you can't see it here, but if you see the steps up to the trading ring, there's also steps down into the center. That's the pit. That would be where what we used to refer to as local traders or local market makers, those were representative of that speculative aspect of our business that we talked about. Those would be individuals trading their own accounts, making markets, taking risk from the brokers that stood on the top step around the outside of the trading pit. You can see in this photograph, there's a fellow with his arms up in the air. He's shouting and waving and expressing with his hand gestures whether he's buying or selling, and he's describing in his voice the amount of contracts and a price at which he would be willing to buy or sell them. It was a very loud, very physical business, but this is what price discovery looked like for almost 150 years. This is what it looks like today. Out in the western suburbs of Chicago, there's a very well-maintained, very secure warehouse full of these enormous computer servers. This is what our business looks like today. It's environmentally controlled. It's got its own backup power generation system. It's very quiet and very, very, very sophisticated. But more importantly to you and I, what this has done for our business is groundbreaking. It actually changed the way we do business in the derivatives business, not just in the US, but worldwide. And A couple of the things that are important here is it's changed our industry in that it's democratized it. You no longer have to know a guy down on this trading floor or have a direct telephone line to somebody who's got direct eyesight into one of these trading pits. You simply need to have access to the internet, and you can see all of our markets and all of our prices in real time. Another aspect that's very important is it's allowed us to consolidate all of that order activity into what's known as a central limit order book. The central limit order book concentrates all of that liquidity into one pipe so that all of it can be seen by Globex at the same time. It increases the size of the bid and offer so that everyone can see it all at the same time. Depending on your provider of your technology, you'll be able to see not just the current bid and offer, but 5 to maybe 10 levels deep, and see exactly what's behind the marketplace. This is an enormous breakthrough. The other thing is it's allowed CME, because of the consolidation of all these orders and the electronic aspect of their presentation, to be able to manage risk in real time, as opposed to a paper trail or a paper order that would take hours to reach the clearinghouse from a risk management standpoint. So the breakthrough here is not just the speed of the price discovery mechanism and the risk transfer, but also the risk management of the entire system has improved because of the electronification of our business. It's also allowed us to move beyond being a regionally American-focused industry to a global business. We have relay systems around the world that move our prices around so that any execution from the Far East in say, Hong Kong or Singapore or Tokyo is received into Chicago at the same time as an order from Western Illinois. This, again, has democratized the business and made it a truly global 24/7 business. Globex opens for business at 4 p.m., at 5 p.m. Chicago time. So today's day session, or today's trading session, actually began yesterday evening at 5 p.m. Chicago time, and we will remain open today until 4 p.m. Chicago time. So our business on any normal trading day is 23 hours a day. That is, again, only possible because of the shift from this old open outcry floor traded price discovery mechanism to the electronification that's now achievable through Globex. We take our name, CME Group, from one of our legacy exchanges, the Chicago Mercantile Exchange. But that's only one of the 4 legacy exchanges. It happens to be our namesake because they were the first of the Chicago exchanges to do what they call demutualize and go from a member organization to a listed stock business. That allowed the Mercantile Exchange to raise enormous amounts of capital, merge with the Board of Trade of the City of Chicago, and then subsequently purchase the New York Mercantile Exchange and the COMEX Exchange. So those are our 4 legacy exchanges, 2 in Chicago and 2 that were located in New York City. Many of our global institutional commercial clients may have had relationships with brokers on all 4 of those legacy exchanges, which is fine, except that at one point they all had their own clearing organizations, which would have meant that anyone with positions on those individual exchanges would have had to post collateral at 4 different clearing organizations. That is very, very cumbersome operationally and also very expensive in terms of the use of capital. What's happened since the creation of CME Group with these 4 legacy businesses is that they now clear one central clearing organization, CME Clearing. That consolidation has led to economies of scale, not just for CME Group and the diversification of our risk through multiple different types of asset classes, but maybe more importantly for our end users, particularly our important commercial and institutional clients. It's resulted in lower margins for them because of offsetting positions on the various exchanges and the ability to match them up at the clearinghouse level. So clearing is now CME clearing is a much more diversified clearing house in terms of the assets that it's positioned against, which makes it less volatile in that sense. But more importantly, allows our member firms and our client base to be able to get these economies of scale across multiple product lines on previously individually listed legacy exchanges. So let's get down to some of the details. It might be important to understand a little bit more about what a futures contract is and what, maybe more importantly, what it isn't. Futures contracts are not assets. They don't convey rights of ownership. In the case of financial products, they don't express accrued interest, nor do they include dividend payments. You can't pledge a futures contract as an asset for a loan because they don't represent an asset. What they are price points in time. And they're legal contracts. They convey rights and obligations to both the buyer and the seller, and those rights and obligations are expressed in the contract specifications, which you can find at cmegroup.com on every single product that we list. It would be important for you as you're investigating our markets and doing your own homework to spend some time on cmegroup.com investigating some of these contract specifications so you understand completely what it is that you're dealing with. Now, because it's not an asset, a futures contract doesn't require the full payment for the notional or financial value of the underlying product that it represents. That means what is required is what's called performance bond, or is sometimes referred to as futures margin. Now, if you're familiar with stock trading or buying stocks, listed stocks on margin, that's different. That's known as securities margin and is an entirely different concept. In the United States, it's a perfectly legal transaction under Regulation T, where a qualified investor can buy 100% of a risk position in a listed stock, but only put up 50% of its value in capital. However, the other 50% has to be accounted for, and that is done through a broker loan on which the buyer has to pay the interest. This type of margin isn't what we're talking about in the futures world. Futures margin is different. It constitutes the security or the security bond of an open position to ensure the performance of the contract. And it's usually a fractional amount of the notional equivalent of that futures contract, somewhere usually between 5 and 15%. We'll see an example of that in just a second. There are two main types of margin on products at CME Group. The first is initial margin. This is the amount of capital that has to be in place prior to the execution of the trade to secure that open risk position. That's what allows you to initiate a transaction, hence the initial margin. That margin is held to secure the risk of the price activity of the contract. So if you've gone long a particular contract and the market moves against you to a degree that the P&L and the risk position drops that initial margin down to maintenance margin level, you will be required to increase your cash or collateral against that open position back up to initial margin. So this is one of the key aspects of your operations team with your brokerage firms. They're working with margins every day, the margins that are required to open the position, and then the cash flows required to keep those positions above the maintenance margin level. You're going to discover or learn more about towards the end the types of collateral that can be posted for margin. They have to be extremely liquid financial products like treasuries or cash, or in some cases other types of collateral that are acceptable to the clearinghouse. And of course, cash is always used on daily variation margin. So we've got these legally binding futures contracts that are standardized, which means every contract at CME, depending on its expiration month and size of the contract, is the same, which means that they're interchangeable. This is important to you and I because you don't have to go back and negotiate to get out of the position that you have on. You simply, if you're long, you simply sell and flatten your position. If you're short and you need to get out, you simply buy the same contract and flatten the position. This is one of the key differentiating features of the exchange traded and cleared derivatives market, is that by standardizing the contracts, they're deeply liquid, they're easy to get in and out of, and it doesn't require any counterparty agreement or ISDA papering or any of that other stuff. You simply open a futures account, gain access to the market, and get in and out easily. This is one of the key benefits of the listed product, say, as opposed to an OTC product, where you have a counterparty risk, but also if you need to flatten or reduce your risk position, you have to renegotiate to either get out or flatten the trade or create an opposite opposing position with someone else. That takes sometimes hours, can take days, depending on the market. In the futures space, as you're going to learn, it takes less than a second. Let's look at an example. You're looking at a very, very abbreviated contract specification description of our leading gold contract. This is the standard gold contract, which is 100 troy ounces. The symbol for the contract are the letters G and C. GC represents COMEX gold. You'll notice in the ticker symbol, there's 4 locations, GCZ3. The Z refers as a letter to the expiration month of December, and the 3 represents the 4th digit of the calendar year. So when you look at a symbol GCZ3, you're looking at gold for December 2023 expiration. Each one of those contracts is worth 100 troy ounces, and they're traded in dollars and tenths of a dollar, or as we would say in the US, a dime. So if you look at a price on the screen of December COMEX gold at $1,941.5, you're looking at a contract valuation or a notional equivalent value of $194,150. That's 100 times the price. That's the financial equivalent value of the futures contract. But as I mentioned, it doesn't require that amount of capital to enter into that position. We'll look at the margin on that. It's usually around maybe 5%. Could be something like, say, $1,300 to secure that open position. The numbers and letters in a contract specification, and because of the numbers of contracts that we have listed, we're really having to get creative coming up with ticker symbols. But you can see, as the example I just gave, gold for December delivery, GCZ3. You're going to see in most of our products some combination of letters and numbers. It's important to understand what they represent and may be different on different quoting screens. So again, do your own homework and investigate according to where you get access to our markets, how that vendor is providing those quotations. If you're curious about the lettering for the months, this table explains it. You'll notice that it starts in January with F, goes all the way down to Z in December. There's no I and no O because they look too much like numbers. But what's the thinking behind all this? Well, in the dark ages, when we still had paper written contracts, you had to key punch the orders in at the end of the day. If you look at any standard keyboard, you'll see that most of those letters are very close to the center of the keyboard, so nimble key punch card operators could type out these things very, very quickly. There are 2 means by which CME settles for final settlement its futures contracts. One is called physical settlement, or sometimes called physical delivery. The other is cash or financial settlement. Let's stick with the gold futures as an example for the time being. Gold is an example of a futures contract at CME that is physically settled, which means that at the end of its life cycle, any open interest, any open positions in that contract, the short position delivers a clearinghouse receipt. It's called a warrant. It's an electronic warrant that's delivered from the short to the long in exchange for full payment of that warrant. Now, this is the point in a physically delivered or physically settled contract where the futures contract actually becomes an asset. At delivery, the short position delivering this warrant or a warehouse receipt if it's an agricultural product actually exchanges the full notional value of the payment for that particular transfer. The long position receives the warrant, actually owns the physical. So at that point, it becomes a physical asset. This is true in our physically settled contracts that include most of our commodity contracts, our U.S. Treasury contracts, our swaps contracts, and most of our leading FX futures are physically settled. The other form of settlement is known as cash or financial settlement, and this is appropriate for our equity index products, our short-term interest rates, and we have some non-deliverable FX contracts that settle to cash as well. The mechanism in this case is to an index valuation where any remaining open interest at the point of expiration is simply settled on a cash transfer from previous day's settlement. Debits and credits are exchanged through the clearing operation, and the contract simply expires. You can appreciate a cash settled contract on something, let's say, like the S&P 500 futures. It would be impossible for the short to deliver fractional shares of the 505 companies that make up the S&P 500 in exchange for payment on each one of them. It would just be a ridiculous operation. So the advent of cash settled contracts allowed us to list things like equity index products and other products that then settle to an index valuation. Regardless of whether it's physically settled or cash settled, there is a convergence in price between the futures contract and its underlying product at the point of expiration. In addition to futures contracts, CME also has options. Options at CME will always be options on a futures contract, which means the underlying product in our options markets will be a futures position. That means that if one were long an option and they exercise their rights, the right would be to an underlying futures position, not the underlying physical marketplace. And this is an important thing to be mindful of because it's a distinctively differentiating aspect of our options as opposed to, for example, the Chicago Board Options Exchange, another exchange in Chicago that trades options. They trade options on stocks, and exercising your option in a Chicago Board Options Exchange contract actually gets you the underlying physical shares. CME's options are options on futures. So think of it as a second derivative. The first derivative being the futures contract, which derives its pricing from the underlying market or physical, and the options at CME being derivatives on the futures contract. So just a point of information there. Now we're going to talk about the actual mechanics and workflow of a futures order through the Globex electronic execution platform. And the schematic here shows the flow. If you start in the upper left-hand corner where the order is placed, you'll notice if you look to the far right, that round circle says central limit order book. Well, before you can even get to the central limit order book, you'll see a couple of pass-fail switches. Credit controls, maximum order quantity, and price banding are in between the central limit order book and the order to protect the central limit order book from erroneous or maybe bad orders. Not necessarily intentionally bad orders, but people make mistakes. It's a human business. If an order fails to pass those switches, it's rejected and can't get to the central limit order book and cause bigger problems. If it passes through those things, gets into the order book, there are actually some things involving our marketplace within Globex that can either pause or slow down traffic to keep a better balance. And we're going to explore some of those. Velocity logic. Some of our orders have trade limitations on them. And then we also have some regulatory dynamic circuit breakers that will slow down traffic. We'll talk about those in just a few minutes, but keep this dynamic schematic in mind as we move forward. Credit controls are set between a clearing firm, and we're going to talk more about clearing firms in a minute, but think of this as your broker. They're set between clearing firms and the customer account. Obviously, every customer is different. They have different capital, different sizing, different ability to do business. What we care about at CME is protecting that central limit order book. So credit controls are established between the broker and Globex management, so that let's say you're a small self-directed retail trader and you've got a $5,000 trading account with E-Trade or Charles Schwab or even APM. You're not going to be able to execute a 100 lot S&P 500 order because you don't have the capital to back up that risk position. The order would be rejected before it could get to the central limit order book. So credit controls are in place to protect both the customer as well as the central limit order book from perhaps an erroneous input on your keyboard. You meant to hit 1 or 10, but you typed in 1,000. That order would be rejected. Each one of our products has what's known as a maximum order quantity assigned to it. And in this case, it doesn't matter what your credit is. If your order that you place exceeds the maximum order quantity, that order will be rejected. It won't get to the central limit order book. Now, this is set by our business line management team and the Globex command group, basically to protect the market from what used to be referred to as fat finger errors. Again, a keyboarding, if you meant to put in a 100 or maybe a 1,000 lot order, but you type 2 extra zeros, a 10 or a 100,000 lot order may not be acceptable. Each product has its own max order quantity, and that's determined by the size and the open interest available for that particular contract in that particular expiration month. If you want to know what they are, contact your broker or go to cmegroup.com where we publish that information. Another thing that may affect an order before it can get to the central limit order book, and it depends on the product. Some of our products have what are known as price banding restrictions. And all this is that the order getting into the central limit order book can't exceed plus or minus the price of the previous executed trade by a certain degree. This is an example of crude oil, which has a 50-cent price banding restriction. So if the previous trade was at $71 and your order to buy was higher than $71.50, or your order to sell is below $70.50, that order will not be executed. If it were 1 penny plus or minus, let's say 71.49 or 70.51, it could be. A lot of people would ask, what's the point of that? And think of it as like a guardrails on a highway. If any of you have driven through, let's say, mountainous areas in the Alps or in Europe or in some mountainous areas, a lot of highways have guardrails to keep the cars from going off the road and falling off a cliff. That's what these guardrails are designed for in price banding. It isn't to restrict the flow of traffic. It's to control the flow of traffic within a certain defined space so that you don't get very big, large, fast market spikes above or below the previous executed price. Now, as you're going to see when we get to the end of this little section, that speed of transmission of our orders means that that last traded price is changing in less than a second. So the price banding moves dynamically with the last published trade price. So the idea that there's any restriction on activity here is not the case because of the speed of the transmission. That guardrail system is moving up and down with the last trade, which is moving around in less than a second. Once these orders are in the central limit order book, we have programming in place, and again, this is only the result of electronic execution where this can be implemented, called velocity logic. And velocity logic's intention and design is to slow market activity down if it gets too far too fast. This is to mitigate and reduce the negative effects of fast market breaks or rallies that can be very, very detrimental to the trading ecosystem because invariably you get these huge spikes or drops in price that don't represent real price discovery. So velocity logic could be thought of as like a speed bump in a parking lot. If you're going to go out Saturday and go shopping with your family and you go to the local mall, you'll notice in many cases they have those humps in the driving area that slow traffic down, because you don't want somebody driving through the parking lot at 60 miles an hour. They're going to hurt somebody or seriously hurt themselves or someone else. The speed bumps are there to slow the traffic down. That's what velocity logic is. It will, in fast changing market conditions, necessarily slow the traffic down, not cause it to stop necessarily unless it hits a stop period, but will slow it down to a 5 to 10 second period so that conditions can catch up. Buy and sell orders can catch up with the price, and the matching of those buy and sell orders is much more efficient, resulting in a less volatile and violent price action in either direction. If that price action is so severe that it reaches what's called a dynamic circuit breaker event, trading can actually stop for a short period of time. Sometimes it's just a matter of seconds. Sometimes it can be for minutes. And in the case of like stock index products that have a regulated stop, should the change in the daily price drop by 20%, all U.S. equity markets will stop trading for the day. This has been put in place since the financial crash, market crash of 1987, where we had a 23% drop in prices in one trading session. It's not uncommon for dynamic circuit breakers in the short term to be triggered, particularly overnight, but we haven't had to shut down our markets since because of dynamic circuit breakers, we haven't shut down at all. Now, in a lot of cases, these are implemented not regulatorily, but by CME Group itself. Some of our agricultural products actually have daily trading limits, and that means if the price action should reach a limit move, trade can stop. In other words, if there are so many buy orders that you hit the upper end of a price limit and there aren't enough sell orders to fill and satisfy those orders, trading can cease until enough sell orders come in to match those buy orders. That might be the next trading day. So also be mindful of, if you're trading ag products, whether they have daily trading limits. Some have, like Bitcoin, which can be very volatile, have dynamic circuit breakers as well as daily price limits. So again, it would be important to check the contract specifications of a product to see what those dynamic circuit breaker levels are, or in the case of this, also a daily limit. All of these are designed to protect the order book from big moves over a short period of time. In addition to that, we have, because of the advent of algorithmic or computer-generated trading, instituted message controls, which once an individual firm has generated a certain number of impulses into the system, buy and sell orders that haven't been filled, or just flooding the market with messaging, their cost of putting in those orders increases. It's like a user tax on these algo funds, and all that's designed to do is to all those messages after a certain point slow down the latency of the system. So by instituting message controls, we're trying to keep our system flowing at its maximum amount and speed as possible. And since those algo books are making their money on a paper-thin margin, the message control number is important to them, because once they've reached a certain number, it costs them more to place them, and they necessarily slow down their transmission. So if we get through all of these things, the order gets through those pass-fail switches, gets into the central limit order book, and in most cases, as things are operating as per usual, that order can be filled, reported back to the clearing firm, and reported back to the client in less than a second. I don't know what a millisecond is, but they tell me that it's faster than you can blink your eyes. That's the speed at which we're doing business at CME through Globex. That's the speed at which you would be able to see your fills in our system, regardless of where you sit in the world. After the trade's been executed, The post-trade risk is managed by the clearinghouse, and they provide a huge amount of risk management functions that we're going to explore in the next few minutes, but it may be important to start with what is the relationship between CME and our customers. Again, this schematic shows you CME on the left, customers on the far right. Notice that in between, in order to gain access to Globex and the other means at which you can execute contracts at CME, there is this important column called clearing firms. Clearing firms are the intermediaries between CME and customers. No customer can open up an account directly with CME. They have to do it through an intermediary, either an FCM, which is a futures broker, or a clearing firm directly. In other words, an FCM can be a clearing firm. It may be a customer of a clearing firm. CME only does business directly with clearing firms. We hold the clearing firms accountable for the behavior and financial obligations of their customer business, hence their role as an intermediary, and they in turn report and have to be accountable to CME for their behavior, both for their own house business and by extension, the customer business that they represent. The clearing firms perform an enormous amount of very important obligations and responsibilities to be a clearing firm. And in exchange for those responsibilities, they're allowed to charge fees for providing access to our system. One of the things that they do, one very important thing that they do, is obviously collect and then post the margin monies that are required to keep positions open in CME products. From a customer standpoint, clearing firms must legally segregate those funds for customer margin from their own house trading activities. In other words, there is no commingling of funds with house and customer business at CME, and those segregated funds for customers are held in segregation all the way up to that top horizontal line that says settlement banks. A settlement bank is a bank that's chosen by CME Clearing because of their size, their operational efficiency, and ability to do business with us at the speed at which we do business. There's, I think, somewhere between 9 and 12 settlement banks. And you would recognize them. They're the main large global iBanks. They hold these accounts, segregated accounts, up to the settlement bank level, segregating house and customer trading accounts between their customer and their house business. That margin money is held to secure those open positions. But in addition to the margin monies that they hold, the clearing firms also have to put up additional capital at the settlement bank level to secure the whole system. That additional security includes either legacy memberships in our exchange, legacy exchanges themselves, or it might be the common stock of CME Group. On top of that, they also have to participate in what is known as the guarantee fund. And the guarantee fund is capital that's held at the settlement bank level to secure our entire ecosystem. So when a clearing firm, which is assigned its guarantee proportion based on the size of the positions that they're holding in open interest, that's meant to mutually guarantee not just their own business, but every other clearing firm. So when one becomes a clearing firm, you're not only held responsible for your own business, you are agreeing by being a clearing firm to guarantee every other clearing firm's business as well. If we explore this further, you'll see that there is a flow in that guarantee system to secure the system in the event that a clearing firm should ever default. Other important aspects of the clearinghouse are to do this important mark-to-market calculation. Every day at settlement, CME's products all receive the same, each receives its own settlement price, but that settlement price is the same for everyone. Doesn't make any difference if you're a global international bank or a self-directed trader. If you're long an E-mini S&P 500 futures contract, you get the same settlement price. And depending on the prior settlement valuation, you're going to be debited or credited based on that settlement value. So clearing sets the settlement values. in this important mark-to-market function. They're also maintaining real-time marketing and monitoring of risk positions at the clearinghouse and clearing firm level, as well as down to, in some cases, large customer positions. They're determining the amount of initial and maintenance margin by product, and that can change depending on volatility and market activity in a particular product. And you need to be mindful of that. So you may get a call to increase your margin level because the margin on the contract has gone up, not necessarily because of a detrimental move in your position. They're also monitoring the credit of our clearing firms, and then by extension, they're held accountable for monitoring the credit controls on their clients. This is important to you and I because it shows you that CME never takes a position in any of its products. We act as the buyer to every seller and the seller to every buyer, because in order to have a transaction, a trade in a futures contract, you have to have both a buyer and a seller. CME stands between the buyers and sellers, which means that you remain anonymous to the counterparty on the other side of your trade. And because they're standardized futures contracts, you can get out of them whenever you want to.
David,
yes, sir.
I mean, I'd like this to carry on, but I am very conscious of time, and people may have booked this as an hour, and we're just coming up to an hour now. So just to invite anyone to put any questions for David in the chat, that maybe we could address these now. I really enjoyed that, the life cycle and the stages in technology that get this thing done so quickly always fascinates and amazes me. I also was interested earlier in the conversation that we were having regarding those shorter dated options. Can absolutely echo the popularity of those. They draw a lot of interest from our clients, and also the micro. We watch closely the new micro futures and options which the CME are bringing out. The lower kind of exposure, but then the lower margins which can come from these micro futures and options just makes them, I think, a lot more accessible to traders, and also gives them a chance to diversify. If they're typically an S&P trader, they can then diversify into kind of gold and the energy markets and what have you. That we're following the progress of those very closely. I was wondering if from a kind of I think we've got some questions. Can I see anything? I've had someone message me then about the kind of, in terms of market participants, whether or not you see kind of AI increasing volumes, new participants coming in on the basis of the new technology.
Well, technology has been a major driver of our industry for the last 25 years, and obviously it led to the transition from floor trading to electronic execution. So it's one of those evolving things. Whether I think AI is going to be an important contributor to a lot of industries over the near term. It's difficult for me to say what the impact has been immediately, other than we do have a very large portion of some of our contracts volume is done by these electronic or computer generated trading systems. And some of that activity over the years has been challenged as being, too dominant, or could be too risky for the marketplace. But it's been our experience, has been borne out by several independent studies, that type of trading has actually led to less volatility in the markets because of the contributions they make in that important price discovery and risk transfer mechanism. So anything in terms of the technological improvements in the business that results in deeper pockets or pools of liquidity, I would suggest is very, very good, because it creates, again, a more efficient market. It creates a playing field that is deeper in terms of being able to get things done. So I would think, in my mind, and again, this is more my opinion and not necessarily that of the exchange, anything that does bring improvement to either the discovery of efficient pricing or leads to deeper pools of actionable liquidity, I would see as a favorable improvement. So I think this is a game that's going to be played out in the near term, but will take longer to be able to identify, and appreciate the question. Any other questions or concerns at this point?
You're on
mute. Oh, sorry. I'm just going to say, I'm just going to hand over then some final words. Thank you, David. Our final words from APM Capital's SEO, Mr. Nick Spencer-Skeen. Thank you.
Thank you, Mark.
Yes, once again, David and the CME group, thank you so very, very much. You know, it was great to see the picture of the old pit and the floor, having cut my teeth in the very similar environment back in London, and having spent time on both the Board of Trade and the Merck floor. And I guess that was East Cermak one as well you shown, which I've also been to East Cermak for the data systems. So, you know, it's brought back some of my youth to me, so that was great. But it's very, very educational. Thank you so much. I hope, you know, thank you for everybody who's joined us and participated. And, you know, please make sure you register again for our next webinar, which is coming up, I believe, in 2 weeks' time, where David will be our presenter once again from the CME group. So once again, have a great day, everybody. Thank you so much for joining us, and look forward to seeing you guys in 2 weeks' time.
Thank you, Nick. Thank you, Mark. Delighted to be here and wish you all the very best of luck. Thank you.
Thanks all.
Thanks, everybody.